This video is going to be wrapping up the series on how to trade in the futures market. So, welcome back to Getting Digital with Deja. Mm, 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 mhm. So, today I want to go over the things that you absolutely need to know when looking at a futures contract and about to place a trade. Futures contracts are literally like contracts. Like, before you sign something and go into agreement with something, don't you want to know what the information is inside of that contract? Like, you don't want to just blindly sign something hoping that everything will work out, right? So the same way that you would go over a lease agreement or like an auto loan or anything like that, you need to go over these futures contracts. It's not going to be so heavily in depth or anything like that, but the things that you need to know, you need to actually know. So the first thing that you need to know going into a contract is its notional value. And essentially the notional value for a futures contract is just the value of the underlying asset. So that means, like, say we're talking about crude oil, and remember there's 1,000 barrels inside of one contract. So what you would do is you would times the current price of crude oil times 1,000, because 1,000 barrels equals one contract, and that will give you the notional value. So let's say crude oil is $64 right now. You would times that by $1,000 and your notional value would become $64,000, and that would be how much your contract is worth. Now, that doesn't mean like you're going to make $64,000 off of this trade if it goes well. No, that's not what that means at all. It's just telling you how much you're holding on this trade right now is $64,000. And the amazing thing about futures contracts is that you can hold a trade worth $64,000 and put like a small margin amount in, which means like a small like deposit, down payment, I guess you could call it, to be able to trade that commodity. And it's significantly lower than what the commodity is actually worth, the commodity's actual notional value. So it's very similar to option stocks. You would pay a premium to be able to trade those stocks, to buy and sell those stocks, even though you're not actually buying and selling those stocks. Just like you're not actually buying and selling this crude oil, you're just buying the trade, if that makes sense. So the really cool thing about notional value as well when it comes to futures contracts is that a trader can be able to hold so much notional value and pay so little to be able to hold that notional value. So pay so little margin just to hold so much in an asset or a commodity, which is really, really cool because it exposes the trader to like a lot more of the market to be able to make a lot more money, and it's giving them a lot more leverage as well without having to risk too much. So the next thing that you're going to need to know is the minimum tick size, and this is essentially the smallest possible movement that a financial instrument or a commodity can move. And the tick size is different for each commodity in the futures market, but since we're using crude oil, the crude oil's tick size is 1 cent per barrel. So the minimum tick size is going to give you the details for the third thing that you need to know for the contract, and that's the dollar value of the tick. So remember, we're using crude oil, and if it's 1 cent per barrel and in one contract there's 1,000 barrels, the dollar value of your tick would be $10. So every time it moves, it would be going up or down $10. Now the next thing that you need to know, which is probably the first thing that you need to know, but oh well, is the ticker symbol. So the ticker symbol is just like a little acronym or initials of whatever you're trading. So for crude oil, it's going to be CL, and that's going to be seen as the first letters in any trade that you make for crude oil, because remember, it's going to be crude oil, which would be CL, and there'll be the month of the expiration. So let's say Z, which is for December, and then it'll be one number, which would be the year. So 2025, which would be 5. So it'll be CLZ5. So that's a contract for crude oil expiring in December of 2025. And the next thing that you would need to know is what months that this commodity can be traded, because commodities like especially with agriculture and things like that, they can't be traded year round. So that's something that you need to like look into if you're trying to focus on just one commodity. But the cool thing about crude oil is it is traded all year long, so the months will be all month. So the next thing that you need to know, which is super, super important, is price limits. And remember, as I mentioned in my last video, price limits are set by the exchange, and it's essentially just a range of how much that commodity can move. And if it goes outside of that range, that's when they pause the market to try to get everything back in order, or they will go ahead and stop the rest of trading for that session, for that trading day. Now, the next thing that you need to know is delivery. What type of delivery is it? You have physical delivery, or you have something that's like electronic delivery and things like that, but you need to know this because this affects your price limits. Because when you have a physical delivery, those price limits are basically abolished as it gets closer to your expiration date. So you need to know if this is a physical delivery and if those price limits will go away towards the expiration date. Now, hear me out. As a retail trader, you are not delivering any of these commodities. You are sitting at your computer or on your phone and you're trading these commodities, but in no way, shape, form, or fashion are you getting on a ship, dropping off crude oil, and then going back home. No, that's not what's happening. So the last two things that you need to know for a futures contract is going to be the month and also the year. So with futures contracts, they have this thing called front month, and that's essentially just like whatever month is closest to expiration. So let me break that down for you. So futures contracts usually expire like at the end of every quarter. And remember, there's 4 quarters in a year. So the expiration dates or months for those quarters are going to be March, June, September, and December. So when you're talking about futures contracts and it's talking about the front month, that just basically means whatever month is closest to expiration. So let's say it's January and you want to place a trade, your front month would not be January, it would be March, because that's like the closest expiration date, the closest quarter to expiration. So that's how that works. And then let's say you're in November, your front month would be December. So with future contracts, the front months are typically the most liquid. So those months are when you want to like kind of place your trades for, because there's so much price action going on in the market. And that's when you can make pretty good profits. Or you can have pretty good losses. It all depends on what position you take. So it's also important to remember that not all commodities have the same trading like times and months of the year. So some commodities do go by like 4 quarters, but other commodities like crude oil, they trade year long every single month. So your front month is going to change. So your front month is basically going to be the next month that you're already in. So say like if you're in September right now, 2025, your front month would be October of 2025. And then when you hit October, your front month would be November, and then so on and so on. So it's basically going to be when the trades are most liquid for, because it's closering to that expiration date. So one example of a futures contract that expires quarterly would be the E-mini S&P 500, which is a financial kind of index. And then an example of one just expiring all months of the year would be crude oil. So you see, you have to pay attention to those expirations, because that will determine like when you place your trade and when you'll be most profitable. Now let's do an example putting all the information that we know inside of one contract and see how much money we can possibly make. Also, one thing to note before we go into this example is that futures contracts, they expire on the 25th day of whatever month that you're trading it for. So just thought I'd include that little tidbit in here. Okay, hopping into the example, let's say that we're trading crude oil, which is going to be CL, and the expiration date is going to be October of 2025. So that contract name would be CLV5. So the price of crude oil currently is going to be $64, but we're going to want to know what's the notional value of crude oil for this contract, which is going to be that 64 times 1,000, because there's 1,000 barrels in one contract. So the notional value for this contract is going to be $64,000. The minimum tick size is going to be 1 cent per barrel. So the dollar value of the tick move is going to be $10 per move. And the price limit for this contract is going to be 15% above or below the previous settlement price. So now we checked our trade and the price of crude oil went up 40 cents from $64 to $64.40. So we're going to divide that 40 cents by the tick size, which is going to be 1 cent. So that's going to be 40 ticks. And 40 ticks times the dollar value of each tick would be 10. So that would change to $400 that we just made off a 40 tick move. So if you were holding one contract for this trade, you would have just made $400 in profit. Now remember, profits and losses are determined the same exact way. So let's say instead of crude oil going up 40 and went down 40, you would be at a loss of $400 because it's calculated the same exact way. So let's not forget that that's just the profit that you would make for one contract. So if you had 5 contracts, you would times whatever you made times 5. So it would be $400 times 5, which would be a profit of $2,000. So I hope that that example really put the numbers into perspective and what everything that you need to know, how it all comes in together for a contract, for you to better understand trading futures. Because every single thing that I mentioned in this video is very imperative for you to know, for you to have a successful contract and be in the money and not out the money. Okay, so that wraps up this week's topic, you guys, on trading futures. And tomorrow I'll be back with another video on a completely different topic. But I just wanted to end with pretty girls can do futures trading too. All right, see you tomorrow.